Hello everyone. Today, we're focusing on the three fundamental pillars of smart investing: risk, returns, and liquidity. These elements form what I like to call the magic triangle of investing. First, risk refers to the potential for losing money or seeing fluctuations in your investment value. It's something every investor has to understand and manage. Then there are returns, which represent the profits or gains you expect from your investments. Naturally, we all want good returns, but they often come with varying levels of risk. Finally, liquidity is about how quickly and easily you can access your money when you need it without significant loss. Balancing these three aspects is critical for effective investing. Mastering this balance helps ensure your investments align with your financial goals and comfort with risk. As we go deeper, keep this triangle in mind because it will guide every decision we discuss. When it comes to investing, there's a concept called the magic triangle that helps us understand the trade-offs involved. Every investment decision balances three key factors: risk, returns, and liquidity. You can't maximize all three at the same time. The challenge is finding the right mix that suits your goals. Let's start with risk. Risk is essentially the price you pay for potential rewards. It represents the chance that your investment might lose value or not meet expectations. The good news is that risk can be managed through time, by staying invested longer, and by diversifying across different assets. Next, we have returns, which are the profits you earn from your investments. For example, Indian equity mutual funds have averaged about a 20% return annually over the past decade. Returns reward your patience and willingness to take on some risk. Lastly, liquidity refers to your financial flexibility, how quickly you can convert your investments to cash without losing value. Interestingly, about 75% of Indians don't have sufficient emergency funds, highlighting the importance of keeping some liquid assets for unforeseen needs. The key takeaway here is that you can't have high returns, high liquidity, and low risk all at once. Balancing these three elements wisely is fundamental to making smart investment choices. When we talk about investing, it's crucial to understand that risk is the price we pay for potential rewards. For example, during the 2008 market crash, the Sensex plummeted from over 20,000 to just under 9,000 points, marking a staggering 58% drop in less than a year. Foreign investors withdrew billions, showing just how harsh risk can be if you're not prepared. Now, let's look at risk levels in investments. Low-risk options like government bonds, fixed deposits, or savings accounts offer modest returns, typically between 3 to 7% annually. Medium-risk investments, such as balanced mutual funds and corporate bonds, provide better returns, around 8 to 12% per year. High-risk assets like stocks, especially small-cap funds, or cryptocurrencies, can potentially yield more than 15% annually, but they come with significant volatility. The key insight here is the power of time. If you stay invested in Indian equity markets for over 7 years, your chance of facing negative returns drops almost to zero. Extending that to 10 years, you have an 80% chance of achieving good returns. This highlights the importance of patience and a long-term perspective when dealing with market risks. Let's talk about returns, which are essentially the reward for your patience when investing. Here, we see some of the top-performing Indian mutual funds over 5 and 10-year periods. For example, the HDFC Flexi Cap Fund has delivered an impressive 29.9% return over 5 years and 17% over 10 years. Similarly, the Parag Parikh Flexi Fund has returned 23.2% over 5 years and 18.9% over 10 years. The SBI ELSS Tax Saver Fund shows solid returns of 25.6% over 5 years and 15.1% over 10 years. Now, let's consider how these returns translate into wealth over time with monthly investments. If you invest 10,000 Indian rupees every month for 20 years at a 14% average return, using a static SIP approach, you could accumulate around 1.17 Indian rupees crore. However, if you adopt a step-up SIP strategy, increasing your investment by 10% each year, your corpus could grow significantly to about 2.26 Indian rupees crore, that's a 93% increase compared to the static SIP. This example highlights the power of compounding and the benefit of gradually increasing your investments over time. Liquidity is all about having the financial flexibility to handle unexpected expenses or market downturns without panic. During the 2008 liquidity crisis, call money rates soared to 19.8%, forcing the Reserve Bank of India to inject a massive Indian rupee 185,000 crores to stabilize the markets. Investors who didn't have enough liquidity were compelled to sell their assets at the worst possible times, often incurring significant losses. To avoid such situations, it's important to build your liquidity ladder. This means organizing your funds across different tiers based on how quickly you can access them and what returns you can expect. At the immediate tier, you should keep about 1 month's expenses in a savings account that offers around 3 to 3.5% returns with instant access. The short-term tier, covering 2 to 3 months' expenses, can be parked in fixed deposits, which offer better returns of 5 to 7% but take a few days to access. Finally, the medium-term tier, spanning 3 to 6 months' expenses, can be placed in liquid mutual funds or government bonds that provide 6 to 7% returns with typically 1-day access. It's worth noting that nearly half of Indians have saved less than 10% of the emergency funds they need, and surprisingly, 14% of high-net-worth individuals don't have any emergency fund at all. This highlights how crucial it is to prioritize liquidity. It gives you peace of mind and puts you in control during uncertain times. When it comes to investing, there's a balancing act you have to keep in mind. You simply can't have it all. Generally, if you want higher returns, you need to be willing to take on higher risk and deal with less liquidity. For example, small-cap stocks can offer impressive returns of 25% or more, but they come with significant volatility, meaning their prices can swing wildly. Private equity also delivers excellent returns, but your money is typically locked in for several years, so you don't have easy access to it. The main idea here is that the greater the potential for gain, the greater the uncertainty and commitment involved. On the flip side, if you prioritize high liquidity, meaning you want easy and quick access to your money, the returns tend to be lower. Savings accounts are a prime example. They're convenient because you can access your funds anytime, but the interest rates barely keep up with inflation. Money market funds also offer good liquidity but come with only modest returns. So, convenience in investing often comes at the cost of lower earnings. Lastly, if you're aiming for low risk, that usually means accepting lower returns as well. Government bonds are very safe, but their upside is limited. Fixed deposits protect your capital, but their interest might not even beat inflation over time. In essence, playing it safe means you have to be okay with smaller gains. Understanding this trade-off is crucial for making investment decisions that align with your goals and risk tolerance. Here we have a real-world example from the March 2020 market crash that illustrates how two investors faced the same situation but ended up with very different outcomes. Investor A had 10 locks in equity investments and a substantial emergency fund of 6 locks. When they lost their job during the crash, they were able to rely on their emergency fund and did not have to touch their investments. Because of this, their portfolio stayed intact and over the next year, it fully recovered and even gained value. On the other hand, Investor B had a larger amount invested, 16 locks, but no emergency fund at all. When they also lost their job, they were forced to sell their investments at the market bottom in order to cover expenses. This meant they realized significant losses and, looking back 1 year later, they ended up with 4.5 locks more in losses compared to Investor A. This example really highlights the importance of having an emergency fund during market downturns, so you're not forced to sell investments at the worst possible time. Staying invested and having a safety net can make a huge difference in long-term financial outcomes. Let's look at how you can build your investment strategy in 3 simple steps. First, assess your risk tolerance. Think about how you would react if your investments dropped by 20%. Would you be comfortable staying invested, or would you panic and sell? Also, consider your income stability. Is it steady or irregular? Finally, think about your timeline. How many years until you need to access this money? These questions help determine what kind of risk level you're comfortable with. Second, define your return expectations. For long-term equity investments, you can generally target annual returns of 12 to 15%. If you prefer a balanced portfolio, expect somewhere around 8 to 12% per year. And for more conservative investments, a return of 5 to 8% annually is typical. Aligning your goals with realistic return expectations is crucial. Third, plan your liquidity needs. Make sure you have an emergency fund covering 6 to 12 months of expenses, kept in safe and liquid assets. For medium-term goals, those within 2 to 5 years, consider balanced funds or debt instruments. And for long-term wealth building, think about an equity-heavy portfolio, which tends to offer higher growth over time but with greater risk. By following these 3 steps, you can create a strategy that fits your personal situation and financial goals. Here are some key statistics that every Indian investor should be aware of. First, a staggering 75% of Indians do not have an emergency fund, which is crucial for financial security during unexpected situations. Then, looking at returns, Indian mutual funds have delivered an average return of about 20% over the last decade, showing their potential for growth. Notably, 100% of 8-year systematic investment plans, or SIPs, have delivered positive returns, highlighting the benefits of disciplined, long-term investing. During the 2008 market crash, the Sensex fell by 58%, reminding us of the risks involved in equity markets. However, if you stay invested for 7 years or more, the risk of loss becomes almost zero, underscoring the importance of patience and a long-term horizon. Lastly, it's concerning that 47% of Indians have saved less than 10% of what they need for an emergency fund, emphasizing the need for better financial planning. These stats together paint a clear picture of why building an emergency fund and investing with a long-term focus are essential steps for financial health. Let's talk about mastering the investment triangle: risk, returns, and liquidity. These 3 elements are the foundation of any successful investing journey. Understanding and balancing them is crucial to securing your financial future. Firstly, risk is the uncertainty involved in any investment, which you need to be willing to manage. Returns are what you aim to earn, but they come with that element of risk. Liquidity refers to how quickly you can access your funds without penalty, and it's essential to have a liquidity buffer. This buffer allows you to stay invested during market ups and downs. In fact, data shows that 100% of systematic investment plans, or SIPs, held over 8 years in the Indian market have yielded positive returns, highlighting the importance of discipline and patience. To sum up, having the discipline to stay invested through market volatility and maintaining enough liquidity to manage your cash flow needs can dramatically increase your chances of investment success. If you'd like to discuss your investment options or get a free portfolio review, feel free to reach out to me. You can contact me via email or phone, or connect on LinkedIn. Remember, mastering this triangle can help you secure a more stable financial future.